Welcome to the weekend stage analysis video. It is Sunday the 18th of June 2023. Got a lot to get through this weekend as usual. Going to start off with the major US indexes, followed by the future SATA charts, before getting into the industry group relative strength rankings, the key market breadth charts that we follow each week in order to help us determine the weight of evidence, look at some of the stage 2 movers on volume, whether there be stage 2 breakouts, continuations or stocks getting some volume that are close to stage 2 breakout levels. Have a quick look through some of those this week before getting into the watchlist stocks at the end of the video. So for any of the members each week that obviously are going to go through the entire video, normally about an hour and a half in total, but obviously it doesn't have to be all watched in one go. You can obviously break this up into sections, whatever area you're interested in, as a lot of it is not time contingent, especially like the market breadth stuff, and that's more the watch list stocks even aren't particularly time contingent, as it's not an alert service. We're not looking for stocks that are going to be moving the next day, particularly. We're looking for highlighting themes and what's going on in advance of them getting towards the various entry points, etc. So while some might be close to actionable points, the majority might need a bit more time, and obviously we're looking for different types of characteristics. It's all about finding stocks with the stage 2 or stage 1 characteristics, or the characteristics that we look for in the stage analysis method, and obviously highlighting those and looking for the themes. For example, we had earlier in the week I did an hour-long video on the automobiles group, which has been racing up the RS rankings as obviously mega cap Tesla started to break out into stage 2 a few weeks ago, and we started to get some secondary stocks from the group breaking out as well into stage 2 and starting to move up to the top of stage 1. So it's moved all the way up to second place in the RS rankings. So as part of what we call the forest of trees approach, that's a group potentially worth looking into. So obviously the increase in the relative strength and stocks moving into close to potential actionable areas in the method. So we'll get all into the rest of it in a bit. So going back to the start here. So as I said, for the members, anyone that wants to break up the video, you can use the chapters feature in the bottom right of the screen. There's a little button at the bottom that you can click on, and then that will pop up the chapters and you can jump to whichever section you want, or use the bar along the bottom. Right, okay, let's get started with the major US indexes now. So S&P 500, beginning with, as always, was our key sort of guideline that we use, as we use this for the Mansfield relative strength indicator. So it's our key sort of guide to go against what stage the market's in as such. But we obviously look at all of the indexes. We look at the market breadth in order to determine the market stage. But the S&P 500 is our sort of universal guide as such in terms of relative strength. So been moving out into stage 2 now for multiple weeks now. We've got 3 weeks of definite move out, but obviously it did start to break out into stage 2 earlier than that, but it was still underneath a zone of resistance after the failed initial stage 2 attempt here, where it came back underneath that 30-week moving average, would have knocked out that investor stop loss, and then it started to push back out again through this area. But on a daily basis on that, it was still within this resistance zone, and so not until this point up here on the daily chart back in early June here did it actually make a clear move into stage 2, but has been in stage 2 for multiple months now technically, but only 3 or 4 weeks now more clearly here. So as you can see with that, the breadth has started to expand on the percentage of stocks above their 50-day, 150-day and 200-day moving averages combined. So this is a custom indicator that I do for the stage analysis members each week. This is an equivalent indicator to what Stan Weinstein's stages survey, where he looks for the stocks that are technically healthy in stages 1 or stage 2. So this gives you a good rough approximation of that. At the moment, we're at just over 55% of this started to break out of this zone that had been in for multiple months through April and May, started to advance as the market has started to advance. So still in a neutral range at 55%. We can't count the 40 to 60% range as the neutral range. So whether it be stage 1 or stage 3. and above 60% tends to be a more stage 2 environment. So at the moment, although the S&P 500 itself here is in stage 2, this is looking at all the stocks in the market, the Nasdaq, the NYSE, etc. So it's a much broader measure, and this is only at 55%. So not yet in stage 2. On a market basis, we're still in what we consider a neutral plus environment. So we're on the positive side of neutral, just above that 50% area there at 55% at the moment. But if it does start to continue to push out, start getting above this 60% level, start holding up in this range, that would be considered a market stage 2 environment, which you can see if you go back to the previous time, back through the last time we had a stage 2 advance in the market through 2020 into 2021, it was obviously above the 60% level for a long way, all the way through until July time, where it started to break down. So while the market was getting into the later part of stage 2, you can see the market breadth started to tail back off into a more neutral type of environment. Then as the market started to roll over at the top, you can see the market breadth itself was breaking down below 40%. So at this point here, as the market was topping, you can see the market breadth itself was much weaker in this below the 40% level. And then as it started to move off down, so go back to the S&P 500 at the moment. This has got the 3 ATR levels on it. So what's considered versus the 21-day exponential moving average here. So we use a 21-day exponential moving average on the daily chart with a 50-day moving average, simple moving average, and a 200-day moving average. So the 21-day is used because there's 252 trading days in a typical year. So if you divide by 12 for your average month, 21 days is your typical month. So it gives a good proxy on a daily chart I've found over the years. And so with this, we have the 3 ATR level. So above the 1 ATR level, this first level here, plus 180, you tend to be in a short-term uptrend. So you can see here, we've been above the 1 ATR level through this area here. Once you get above the 3 ATR level, which we have been currently for the last few days, it's short term a little bit extended, so often needs time to pause, consolidate, potentially pull back towards the moving averages. But when you're in a short-term uptrend, you tend to want to see the stronger the better, in terms of it holds above the 1 ATR level, it's much stronger, but you get occasional pullbacks to the 21-day, and then when you start breaking that and coming back further back down, obviously you're getting into more significant correction territory. Percentage of S&P 500 stocks above the 20-day moving average at the moment remains at very high, 87.2, but when you're in a short-term uptrend, you tend to hold in the upper zone. So it's not until you start breaking back down again. So you tend to, if the market's trending higher, continuing to move higher, then this tends to hold in the upper zone. So while it seems overbought as such, it's not really. You want to see it overbought. You actually, once it starts breaking back down again into the more neutral zone, that you start to be worried and you start to get a short-term sell signal on that. And obviously that's when you start to get reversals in this. But at the moment, as long as it's above in the upper zone, it's in a strong position, but a little bit extended in the short term at that plus 3 ATR level. But on a weekly basis, if we use the same technique on the weekly basis with the count the channels, we can see we're only above the 2 ATR level at the moment. So we're not yet up to the 3 ATR level, which it rarely gets to. You can see back in 2021, it had a touch a few times getting close to it, but majority of the time it stays within the 3 ATR bands, and you tend to trend when you're in a stage 2 uptrend. As you can see through here, you tend to be above the weekly plus 1 ATR level for the majority of the time. Occasional pullbacks below, but you can see the majority of a stage 2 advance tends to hold between the 1 and 3 ATR bands. And so at the moment, we're in the sort of short-term extension, but we're in a short-term uptrend. So we've got 3 weeks now, actually 5 weeks now, above the plus 1 ATR level, which we haven't been above, as you can see, through the entire stage 4 decline through here. We hadn't been above for a long time there. We had a little pop above it for 1 week and then started to come into it again more recently. So we've now had 5 weeks above the weekly plus 1 ATR level. So we're starting to move off out here into a clearer stage 2 advance. And with the percentage of stocks above their 200-day moving average at 65.6%, we're in a more bullish position there. Because as I said, above 60% is what we consider more of a stage 2 type environment. So in the S&P 500, we're in a more stage 2 position with the longer term moving averages more than around two-thirds of their stocks above their 200-day moving averages. Move on to the Nasdaq 100. It's obviously very extended in the short term, but reaching its upper channel line. I'll show you that on the futures chart in a later part of the video. But at the moment, a little bit short term extended, so butting into overhead resistance a little bit from its channel line, but very much a technical level. So been in stage 2 for obviously multiple months now. The percentage of stocks above their 200-day moving average in a strong 78% at the moment. So while short term extended, it's obviously in a very strong breadth position. And again, as you can see, through the 2020 into 2021, above the 70% level there, even it held all the way through this area and didn't start to break down until this point here, when the breadth started to tail off a bit here. And then so through this topping area here, the breadth had started to move back down into the more neutral middle zone, and then as we started to break down into the stage 4 area here, it started to tail off into the lower end of the scale. So at the moment, we're in the upper part of the scale, we're in a stage 2 environment. So as long as it holds above the 60% area, it's in a strong position, but obviously short-term extended. Again, above its free ATR level on the daily chart here. So it's been running up the free ATR level, so very, very strong. Again, percentage of stocks above their 20-day moving average at 88% at the moment. So again, holding in the upper zone at the moment until that starts breaking back down into the mid-range there. Obviously, no concern at the moment, just looking for consolidation pullback to occur. So Nasdaq Composite, same as the Nasdaq 100, really a little bit obviously lagging in terms of the Nasdaq 100, which is stronger with the mega caps leading at the moment. 42.79% is much weaker above their 200-day moving average. It's the weakest of the two major indexes, the Nasdaq Composite and the NYSE. So this is only at 42.79%, whereas if we look at the NYSE quickly, that is at 60.26%. So coming back into this, still looking for this to improve. It's only just coming out of the lower zone, so quite weak in a broader basis, but obviously those mega caps etc. have been helping lead this higher into stage 2, and we have got a short-term uptrend developing coming out of that lower zone and starting to move up. So it's in a strong position at the moment. Obviously still only just moving into the neutral ranges, but same with the Nasdaq 100, short-term extended at a upper channel line there. So again, on the daily, similar kind of position. We'll stick the free ATR candles on that. You can see running up at the free ATR level there. So go back to that. NYSE, on the other hand, we have obviously had expanding breadth, which has started to help the market move. The last 3 weeks, we've had strong move in the NYSE, which had been holding back the market for a while. So while the Nasdaq had been running higher in stage 2, this had been pulling back, consolidating from obviously these significant bars from the banking crisis there. You can see we finally this week got closed back above that significant bar from when the banking crisis began at the start of March there. So this was the first close above that and started to break resistance in the near term here. We also, you can see the percentage of stocks above their 200-day moving average moving above that 60% level, which is, as I said, key for a stage 2 type environment. So we did have a brief pop above in January, February there before it rolled over again. But at the moment, if this can continue to push out and move up into this upper zone, then obviously this NYSE could follow through into stage 2 also. But at the moment, although it's broken a near-term pivot here, still obviously you can see there's multiple pivot levels through here and this major zone of resistance all the way across the chart, which obviously has been tested numerous times throughout the course of the last 2 years or so. So this is the key level to watch, and we start to get a significant move above this 16,000, 16,250 area, then the NYSE could turn into a stage 2 itself. But at the moment, technically still in consolidating in a stage 1 base at the moment in a sideways range here. So Russell 2000 testing that stage 2 level as well for the last 2 weeks. Again, got a very strong resistance zone across here and a few failed attempts. The last failed attempt back in late January, early February, where it rolled over again, that significant bar from the banking crisis there, which this one has not yet broken above. So while the NYSE is stronger, closing a little bit higher above here, the Russell has not. So the Russell can actually push through to this area here. It would move. That would then be a new stage 2 breakout attempt. And obviously, we'd be looking for some kind of backup move, follow through. But at the moment, it still hasn't managed. It's still underperforming versus the S&P 500, still below the Mansfield zero line, which is the 52-week moving average of the relative strength of the Russell 2000 divided by the S&P 500 there. So still very clearly in this stage 1 structure here. There's a broader structure, however you want to look at it. So that's the broader structure, which it would need to clear convincingly, but that would not need to move above that to get into stage 2. We've got multiple levels here from these lower levels that have been tested through here. So this is the key level at the moment, also back in May, June last year. So this zone through here is what we're watching. So if we can get a strong move above this 190 area, then that would be a stage 2 breakout attempt. Daily, you can see more clearly on this. So you need to get a move through this area in order to move into stage 2. If it rolls here, obviously short-term up thrust again would be a further failed attempt. Obviously be looking for it to come back down towards that 200-day moving averages if it does. But if we drop down to a lower time frame on this quickly, you can see that I've talked about how you can use the lower time frames to help you fine-tune your entry points on these. So you can see the stages. You've got stage 2 into a stage 3, down into stage 4, then developing a new stage 1 through here. So you've got this change of behavior move here with the initial base structure starting to develop through here. So this is your stage 2 breakout area through here. You can see the volume increased on the breakout. So it had a stage 1 base into a stage 2 breakout on the lower time frame, which is then pushed up. So still above a rising 30-bar moving average on this 2 bars per day time frame here. So just a short-term base structure at the moment. So look at this at the moment. Potential reaccumulation base could still roll over and turn into stage 3 on this time frame. But obviously, if this can continue to follow through, 30-bar moving average continue higher, then obviously we could have a stage 2 continuation back up towards the upper part of the range here. So that's how you can use the lower time frames as an example of using stage analysis to then fine-tune your entries. As on the daily chart, that stage 2 breakout was at this point down here. So obviously 3 weeks ago there now. Right.